Okay, good afternoon. Check, check, radio check. I want to welcome everybody. This is our weekly chat with Chris. It's Thursday, January 19th. If you've not been on these calls before, typically the format is we've been doing this since COVID came around. And then as we have progressed, it's sort of got a little bit of a following. So it's really educational in nature. You know, I try and bring different topics, different venues, things of that nature. To be able to share with the community, clients, the public, some of my advisors, clients. I mean, just a broad spectrum of folks. And, I thought about, the topic and I said, I've been doing a monthly sort of recap, and that's going to continue. But I felt that it was a little bit of a blend of market forecast and GPS, because forecasting is sort of looking out into the future, and then GPS is sort of where are you right now, and then where do we go from here. So I may adopt this as our new title on a go forward, and I'll do my best to just give you where I see we're at today. But the data that we're going to share is from last month and last year, so you might go, well, what good's that do us right now? And you'll see here shortly. But with that said, just sit back, relax. These calls typically go 15 minutes to 30 minutes, depending on the topic. And again, if you have any questions after we're done, please reach out to us. And thank you again for being on board. So without any further ado, let's see if I can do this. And so I put this slide out here because I felt this was important, and that's RMS, rear mirror syndrome. When we're going down the highway and we're trying to go somewhere, it could be a cross-country vacation, could be the way to work. We have to keep an eye on what's behind us, but we don't really become so infatuated on what's the past has happened that we take our eyes off the road, right? So, the future is impossible to predict, right? We all know that. It goes without saying. It's common sense. But when it comes to forecasting and especially in investments and even more pointedly so to our retirement plans, we have to have strategies as we start to look out into the future. So, you've heard me talk in the past that whether I'm a pilot, a ship captain, or driving a bus or a car to a destination, there are signs or patterns that we can start to assess information from that can cause us or allow us to make reasonable corrections. Example. So if I was in a plane and I was flying to San Diego, I'm the pilot, right? Couple things. If I hit turbulence, the pilot's going to turn around, come over the loudspeaker and go, ladies and gentlemen, we're about ready to hit some turbulence. Please put on your seatbelts. And then please stay seated until I turn the sign off. I am of the opinion right now that we should all be wearing our seatbelts. It's not that the sky is falling, the plane is not crashing, but there are things that we can do to protect ourselves through turbulent times. And that's really what I wanted to be a takeaway as we start to look in forecast. Forecasting is impossible, but we can start to develop strategies. Now, one of the things that, everybody's sort of trying to predict, I think everybody's in agreement that we're heading into a recession. If we're not there already, we're right on the cusp. The question is, do we have a soft landing or is it going to be a hard landing? And the difference will be, if it's a soft landing, then we should start to be in a position to start to buy stocks in the future. If it's going to be a hard landing, then we want to rally around bonds or bond-like vehicles. So you'll start to see, we'll talk more about that as the year progresses. Again, I don't have a crystal ball, but I was saying last year about this time that by the third, fourth quarter of 2022, things should start to change. And that, I think, is evident. I mean, there's a couple things going on. Nobody could have predicted Russia being invaded by Ukraine. Nobody could, we didn't know what was going to happen during the midterms, right? Now you have Russia and China talking. You have Rocket Boy turning around and rattling his saber. You have, a border crisis unlike anything that we've ever seen. You actually have people now starting to wake up and look down and go down to the border and go, oh my God, this is a crisis. I mean, we can't panic, but we also can't ignore. We can't take an ostrich approach of some of the signs, signals, storm clouds ahead, because any one of these things, these storm clouds that if I was the pilot, could cause either more turbulence or corrective action altogether. So I used this slide last week. I've used it in the past because this is about 120 years snapshot. It's not all the way up to 2023 yet, but it's up to 2020. And, it just shows that even as much volatility as we have right now, we're only going to be looking at a 1-year snapshot. We're not looking, even when I look at 10, 20 years, right? We're going back over here. This is in the 2000s when the internet bubble burst, and then this is the housing bubble burst, and they were absolute crises, right? But in the scope of things, in the bigger picture, things tend to, especially in equities, over time, tend to keep moving. The economy, and this is where we're getting mixed signals, right? The weekly employment reports, unemployment rates, things of that nature, actually, consumer spending are showing positive signs. The counter to that weight, though, are manufacturing, right? Some of these other, business-like decisions, right? Hourly rates for employees, just different types of assessments of the market are sort of leaning towards, just different signals. So we have to be cautious. We have to proceed with caution. Again, I'm not Chicken Little. The sky is not falling, but it also allows us, and it may create some opportunities. And again, these calls are not designed to be investment advice. They're just here to sort of be bellwethers as to what do I see as we go forward. So this is for the month of December in the equities market. And as you can see, everything was down, right? So, for me to spend a lot of time on the different indices and saying, hey, whether it be American, which is purple, right, the S&P, or the Dow Jones, which was orange, or the Russell, which is small cap, light blue, right, that, December was not a great month. However, when you look at the year, I think this is more telling. And this is really what the point I wanted to say. Pretty much everything was down last year, right? So and you don't need me to tell you, just open up your brokerage statements, open up your 401k statements, look at your accounts, and you see that some of this stuff, it's been a challenging year. Now, a lot of my clients, we have strategies in place to help mitigate this loss. But if you're not my client and you're looking for options, and part of this is market forecasting, again, if you can tell me what the market's going to do, I can tell you where you need to be, right? But if it's going to be a soft landing and it looks like things might get better, then we want to be positioned to buy into equities. Now, if you're still working and you're not retiring in the next month, 2 months, year, 2 years, I may even still go so far as to say, you know what, equities might be opportunistic. Now, one of the areas that is starting to look attractive, and again, not giving investment advice, but at least where before I've been gun shy, I start to look at if we're going to invest, right? And the US is heading into a recession. Maybe if you want some growth and you got a little bit of tolerance for risk, maybe emerging markets, this hot pink. I call this China, right? But these are the areas where I think we can start to see a little bit of a rebound. Again, it's just my opinion based on some of the signals I'm seeing, but it doesn't mean that we're selling everything that's US and small chips. But it also, when we go back to the other slide where you can see things could still go further south, which as will be evident by this 10 or 15-year snapshot, right? So this is our bull bear indicator. We still have a red line here. And again, as we look at, this was 2008, right? 2009, as we look at, the internet bubble burst, which was only a blip on that 120-year average. But as we look at 10 to 15 years, you can see that, history, just because, like I said in the first slide, past performance is not indicative of future results, right? So these are all CYA statements, but they're also common sense. They're also like, hey, listen, just because it's happened in the past doesn't mean it's going to happen again. That's both from a gainful standpoint and from a correction standpoint. But I do think that there's some room for further downward pressure, right? So if that's the case, then where do we go? Well, if it's a hard landing, and that's where a lot of the economists and people that have more expertise than I do are suggesting maybe, hey, if bonds and yields are up, maybe we start to step into bonds, at least longer duration bonds. Well, now that I'm on to bonds, how did bonds do in December? A 1 month snapshot, nothing did well. So how about a 1 year snapshot? In a 1 year snapshot, so this is again, these are treasuries, which the year before everybody was in. Now US Treasuries negative 32%. Could you imagine putting 10 grand into US Treasuries for a 20-year Treasury and turn around and it being worth $7,000, right? 1 year later? That's not a good investment strategy. So you got to be careful following trends, right? Also, remember that when we get into the income models, they're called bond and they deliver yield for a reason. And the reason is because quite often when we get to this point where we hang up our cleats, whether that be 65, 67, 70, where are we at from an economy standpoint? Can I live off of my investment? And one of the things that we preach are professional planning services, right? You will hear me say this day in and day out. Retirement planning is about income. Creating a plan to help figure out what our expenses are in retirement, and then what sources can we draw from to make sure that we have income in retirement. And the challenge that I've seen with a lot of traditional wisdom is that, quite often that what's your number? Get to 65 and you got $1 million. Okay. And $1 million, that's your number. You'll be fine. But I cry foul. I cry that's not accurate because it's not a complete picture. There are so many areas from once you hang up your cleats, age 65. Again, I'm a retirement income certified planner. My goal, my job, my expertise is not to get you to retirement, but through retirement. And I often will say, part of my job and responsibility as the pilot, as the guide, as the person that's helping you to get there, what could go wrong? And then do we have contingency plans in place? So right here is a perfect example of what could go wrong. If you followed traditional wisdom and you were in mostly US aggregate bonds, the purple, that's a negative 15%. So if you had $1 million, now it's worth $850. If that $1 million was throwing off 4%, and you were drawing it down with hopes that you never had to tap into the principal, well, now the value of your bonds are at $850, drawing off 4%. Now you're living on less in a rising inflationary environment. And the math behind that suggests that the probability of you running out of money, depending on how long you live, is greatly heightened. You have to deal with people as you approach retirement. As much as you may be a do-it-yourselfer, you may have done this, you may have been following traditional advice, maybe it's time to rethink things, because just like I said, we are in unprecedented times. There are a combination of weights that are against you. My job here is to educate you, to help you to start to rethink what you've been doing, and should we make corrective action, not panic corrections, but strategic corrections. So that's what we can help you with. Again, when we look at the indicator, the one thing I will say is we have a red line, but we're starting to see, maybe depending on what this year looks like, it may be a time to step back into bonds. And this is why some of the advice I've given over the past couple months is if you have a 401k, let me slow down and make sure that I make this point clear. Let's say that you are following traditional wisdom as you approach retirement and your portfolio at your work was 50-50, 50% equities, 50% bonds. The bond portfolio had up to this point been under pressure. I am not suggesting to sell anything, not your equities, not your bonds. What you're there and you're doing right now, that's already been done. Part of the wisdom to investing is not chasing returns, not following the next hot trend. Because if you sell, here's what I can tell you: your costs, it was higher than the current value, you're going to gain a loss. That will be a realized loss, right? And in order to recover from that, it's very, very difficult, right? We're digging out of a hole. However, if you're still at work and you have the ability to adjust your contributions, this is what you're putting on a week-in, bi-weekly, monthly basis into your plan, right? That I will suggest maybe we start to up into the bond portfolios, right? I think there's some wisdom there. So it should be considered. Again, it's not all your eggs in one basket, but it's a strategy that you can start to adjust just with some thoughtfulness behind it. And that's why. So lastly, this is a recession probability analytics tool. It was created by Formula Folios. Now, although December shows that we were as high as 80, so we had a crossover during 2022, that once you get above the 50 percentile, right, the chances of a recession, they have 100 different data points that they use to extract that data to be able to say, hey, we think a recession is probable, right? Well, now with that data, we crossed over, came back down, dipped below, and then we spiked up in October, November. Well, it did drop back down to 68 for December, but you know what? It's still above 50. This is why I said most pundits are in agreement that a recession is probably likely for 2023. So what does that mean as I forecast and look out? A lot of people think you can only have one bad year in the market, and I disagree. I think for every 1 to 2 years in a downward market that you can start to position yourselves for upward recoveries in years for 1, 2, 3, 4 years on a rebound. But we had roughly a 10-year bull run. So we have to be cognizant that, we could still have another tough year, 2023. If a recession comes, I think it will be unlike anything anybody has seen in a long time. Things will get tough, right? And, people will lose jobs, layoffs will happen. Then all of a sudden, we see inflation spiking, right? Last year, inflation was just north of 8%. December was, I think, 6.5% month to month, right? December 2021 to 2022. So these things, all add up to pressure. Now, everybody's pocketbook and bank accounts are different, but we all are in this together. So again, my advice is not to panic, but you know what? Like I said, consumer sentiment right now seems to be positive, right? But how long will that last? Well, as long as things don't get to the point where, people's bank accounts are at zero. Because at the end of the day, when people start running out of money, the government stops printing money, handing out money, right? All these things happen, right? Then now all of a sudden people will say, hey, now we have this real correction in place. And as you saw from that 120-year chart, things could go south, a falling knife. And that's where you don't want to be in a position where you're shooting on yourself and again, I don't know what the future is going to hold, because if for me, I'm not panicking because, it's going to be 20 years before I retire. I'm 58, so it's 78 before I can, stop doing these things. I'm going to be around for a while. But when it is falling, you got to keep contributing to what you're doing. If you're entering into retirement, you may want to take some risk off the table if you can. So guys, ladies, gentlemen, I want to thank all of you for being on here. I have some events coming up this year. I'm going to be doing a Medicare event at Mercer County Community College. in April. If as you approach retirement, you turn age 65, you're looking at Medicare, all these things are important. The costs, you're going to be inundated with decisions on Social Security, all these things I can help with, right? If you have any questions, we're going to ask you to reach out to my office, reach out to me, send us an email. We're happy to help. I hope everybody's well. I hope you continue to show up. Don't keep us a secret. And again, thank you all and have a great day.